their stock price continues to go higher, which is like basically impossible. At this point, it's a paper airplane flying against gravity that has caught hurricane force winds to push it up. And we're just not sure how long this hurricane is going to last.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
How's it going, sir?
Good, man. How about you?
Yeah, doing all right. Doing all right. We got college football kicked off last week, but real college football between Colorado and Texas Christian University, the TCU, the Horned Frogs is happening today. So that's really when the season kicks off. So I'm excited about that.
So when Colorado comes out on the field in mere hours, Douglas,
Prime
they
time.
will be sporting some new kicks, right?
Okay.
And that leads us to the most important part of the episode.
Oh my goodness.
A quiz for you on Nike shoes.
Oh
all
my
right?
goodness. I'm not good at this kind of stuff, but go for it. Go for it.
No, this is the economics of Nike shoes. I'm not asking you to name, the Jordan 4s, Tar Heel colors.
I have a beautiful pair of Jordan 4s, by the way. But continue.
Jordan 4s are great.
Yeah.
You like the 5 or the 4 better?
The 4. I thought we just covered that.
Tough morning, man. So let's pretend that you're selling $100 Nike shoe. There's two companies in this equation. There's Nike and there's Foot Locker. It's a classic example of how the economics break down. So we're dividing that $100 up between Nike's cost to produce, cost to market, overhead, and then Foot Locker's cost, overhead, rent, everything else, and the total profit of each. All right. So any guesses on how much it costs Nike to produce their average $100 shoe?
I'd say $15.
Okay, $22 to produce the shoe. There's like $11 of total expenses and overheads, $5 for marketing, and $5 for freight, insurance, custom stuff. Basically, taking it from somewhere in Asia to somewhere in Europe or the US, right?
Yeah, I wasn't thinking about the marketing. Oh, cool. Get that.
A little bit of income taxes, and then the retailer margin. How much do you think Nike makes on average per $100 shoe they sell?
So this is after Foot Locker takes its cut. I'm gonna say $40.
No, it's about $5. Nike makes $5.
Hold on. So you're saying 5% net profit margin?
Yes.
Okay, go ahead.
Now, that's not what's going to show up on the P&L. In this example, and this example is from soulreview.com based on 2015 and financials. But in this example, they sell the shoe to Foot Locker for $50. So that's the largest part of basically. They are selling this to the end customer for $100, but they're selling it to the retailer for $50.
So in that case, $50 off the top. Then you had the 22 you already talked about.
Yep. Right. Then you got 11 for overhead.
Okay.
5 for shipping, 5 for marketing. So you get $5 left for Nike, right? This is obviously why a lot of people are enamored with direct to consumer, because if you sell the thing on Nike.com, Douglas, there's a reason they're giving you free shipping, because they're not selling the thing for $50. They're selling the thing for $100. Massive difference.
Wow. That was Samsonite. I way overestimated the amount of power that a company like Nike would have over retailers.
Well, and I think this is ever evolving, right? But let's run with the example. So if you're Foot Locker, you buy the thing for $50. Okay. What's your guess on what their expenses look like and what their net income might be?
I mean, I've obviously already failed all this. I'm guessing Foot Locker loses money.
Yeah. So this is what's so shocking to me. Foot Locker, based on these financials, again, they're from a 2015 financial statement. I didn't do the analysis, but I'm trusting it. Actually makes $6 per shoe. Their expenses are only $17 of the $50 they have for margin. And then they do a significant amount of discounting, it looks like. So basically, they're selling the $100 shoes sometimes for $75. but they're still squeezing out $6 in profit. Isn't that fascinating?
Interesting. Yeah. Yeah. I wonder what that would look like now, 8 years later. But that is still, regardless, that is interesting.
I held Foot Locker about this time. The financials were just a total mess, but it was dirt cheap. And that turned into a really nice holding for me.
Yeah. And obviously, I have never held either of these stocks, or else I wouldn't come out with nonsense like I just did. I mean, this is straight up, there's not even, it's just nonsense what I spit out.
Well, the $5 in this example on Nike side was shocking to me because I know, like, just from a cursory glance of their financial statement, at least a couple of years back, their profit margins were greater than that. So this is I didn't set it up appropriately because I should have said, like, when a retailer is formally involved, what's the profit margin on $100 shoe?
Still, that's cool. Thank you. That was like a proper quiz. Our quizzes are usually about bees in California or pizza places in Alabama. So this was a proper finance-oriented quiz. Well played. Very well played. I heard we got some listener mail.
We do. Hit that music, Doogles.
They fight and fight and fight and fight and fight. Fight, 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 fight. The Skippy and Doogles show.
All right, this is great listener mail from Adam, fellow value investor who I really like. So, Doogles, I'm going to let you do most of the talking because I don't really have beef with this listener mail, but I expect that you might. He mentions some of the details on Cape, which we talked about last week in the mean reversion conversation. I don't think I'll go into the details there, other than I know we've mentioned this on the show before. There were some accounting changes in the early 2000s that are relevant when you're looking at Cape long term. That's a cyclically adjusted price to earnings ratio. Very good points on that front. The fun part, I think, with this listener mail is a real live example. And I don't think we'll get down to the nitty gritty numbers, but we'll talk through the high level concepts where he explains that in some cases for value investing to work, you don't even need mean reversion to happen. Again, huge smile on my face over here. This is like whatever type of bias. There's like 7 biases here that all relate to me having a smile on my face because it's someone saying value investing works. I just love it.
I think we do need to hit on the points, what he stated, though, because that's what the reactions are going to come to. Do you want me to summarize?
Go for it. Walk us through it.
Okay.
Yeah.
It's very well laid out. And then I'm going to lean into it, mostly because this is not even about you, Adam. I appreciate you sending listener mail, and it's very well thought through. I just like, even as a vegetarian, I still like beef. So I'm going to lean into it because that's what I do. So the example is saying, as you stated, that the original theory of value investment does not require mean reversion. Here's what he lays out to be illustrative. You have 2 stocks. One, let's call it stock good. The other one, stock bad. 2 identical companies. They each cost the same amount, and they each pay a $1 dividend. The dividend is a very important point here. There's an assumption that value investment is necessarily like flagged on dividends. That's like a really important assumption for this, which I can understand where that comes from. But
yeah,
really
and that's just in this example. I don't think there's a broader point there, but I think using this example helps explain the fact that mean reversion is not always necessary.
Yeah, but yes, okay. I'll give you that. Okay, so you have the 2 stocks. They're reinvesting dividends. So the day after you buy good stock, it doubles. The day after you buy bad, it drops 90%. So the good stock doubles, bad drops 90%, and never comes back to its original value. Mm-hmm. If you take these good and bad stocks and you go out to the end point of the analysis, there's another 50% drop in bad. So this has gone, I would state, from bad to worse. My words, not Adam's. Now, you never get this mean reversion. So which stock ends up being worth more at the end? What Adam's saying is because of this dividend reinvestment, in the good stock, you end up with 1.63 shares, each worth $40 per share. So you got about $65. On the other stock, because it's been dropping so much and you're reinvesting dividends, you wind up with 3,325 shares of bad. Now that $1 per share that you have there is worth $3,325. So he's saying the bad stock has ended up, because you've been buying it over time is end up worth more. That's the summary. Did I do it justice?
Yeah, I think so.
Okay. And this is why at the beginning I stated the dividend point is very, very important, because if you don't have the dividend here, then you have one stock that's gone down to 99% or down to like whatever it is to nothing. And you have another stock that has gone up. And so the dividend is a very important point here. But what he's saying is you never need the price to come back in that point because you are underpaying for that stock. That is the point that Adam's making. And I get that in the dividend world, partially. If you play out the academic example, I think that's true. You also have to assume that this stock that has gone down 90% and then 50% has voted to continue paying its same absolute dollar dividend.
The stock started at $20 a share in this example, went all the way down to $1 a share, and it was still paying $1 per share dividend. It's pretty extreme.
We will give out the full value of our company in dividends. Yes,
Well,
that is going to be worth
per
more.
share. Yeah, I mean, yeah, it's obviously an academic example. It's a fun academic discussion point, though.
It is,
right?
It is.
Because it's very true that, I mean, Doogles, I think your initial reaction was like, this is such hogwash because this is not the world you play in. But there are certain stocks like AT&T used to be one of them. There's certain these deep value ones where basically people are signing up for the dividend, and sometimes the dividend's ridiculous. Sometimes the dividend's like 8 to 10%. And that, I mean, this is kind of Kohl's right now. The stock's gone way down from $60 a share, and they haven't touched the dividend, and they don't plan on touching the dividend. Then now, if the share price goes down another 50%, they probably have no choice, because you get to the point where people start hollering at you when your stock performance is so low. There's a reason there's not a standard like 20% dividend stock out there outside of maybe the REIT world or some other unique mining situations, because it's not sustainable for your company. But it's still a fun example to be like, why are you actually buying the investment, and what downside protection do you have?
Fully agree with that, because again, it's an academic illustrative example, and there could be a lot of details behind this that you could say, oh, that is a wild, undervalued organization. Like because it's $20 per share, who knows what the market cap of that is, right? So I'm going to make up something. Let's say it's $20 per share. Market cap is $200 million. And the company has $1 billion of cash on the balance sheet. You're like, okay, that's strange. And it's kicking out a lot of free cash flow. And it just keeps pumping out the dividend. And maybe the market hates it for a variety of reasons. It could, like, there's so many reasons why the market could hate this stock.
Yeah, another decent example here might be like tobacco stocks, where the market for 40 years has been like, well, this company's dying. Like, I'm not sending my capital that way. But the tobacco stocks over here being like, yeah, but I make money. I make money every quarter, every year, and I got to do something with that money, and I have to make this attractive for people to buy my stock. So the easiest way to do that is to throw money back in their hands as rapidly as possible.
Precisely. Thank you, Adam. Really well thought out.
Yeah. We love listener mail. Hit us, skippydoogles@gmail.com for more.
There it is.
I want to talk Tesla. I had this crazy hypothesis I had a while back, like a year, that I said, I think electric cars will be more like television sets than they will be like historical old school ICE automobiles in terms of pricing.
Hold on. ICE? Internal combustion engine?
Stands for internal combustion engine.
Okay. Yeah. I was sorry for a second. I was like, electric vehicles will be more like televisions than they are like ICE. I don't remember that part of the hypothesis. No, I get it. Yep.
Thanks for clearing that up. Tesla did price cuts again this week. I've been told that in Colorado, there's one new vehicle you can purchase, and this is across electric and internal combustion, that's less than $30,000. A Tesla Model 3 now, after a federal tax credit and a state of Colorado tax credit, this is true in California and a lot of other states, is like $24,000, Doogles.
Wow.
It's crazy.
Yeah.
It's basically becoming the cheapest car you can buy. Now, the federal and state incentives put things out of whack here. But here's what Tesla has also done with their two top models, the Model S and the Model X. The start of the year, the Model S list price was $105,000. They've had 1, 2, 3, 4, 5, 6, 7 price changes this year, which is insane for like a Ford or a Toyota.
Yeah, it's one per
change
month.
your model price. Yeah, and most of those have gone down. The current price of that car is $75,000.
Wow.
The Model X started the year at $121,000. Same thing, 7 price changes. Currently below $80,000, which gets you into getting the federal tax credit range. These are like 30-40% cuts, Doogles. And I know Tesla is run by Musk, and he's a little different, I'll say, in terms of your average CEO and how he approaches things. But this is a brave new world for car price movement. Like, I've never seen anything like this in my life.
It raises the question for me of what business are they in? And I believe that Tesla views itself, Elon Musk specifically, probably views Tesla as in a different business than the market views Tesla. And there's a place that Elon is taking that company to that is might be more similar to, I don't know if he's using televisions, right, as the analogy, but is more similar to a ubiquitous good, let's call it, than it is a car company would typically view themselves.
I mean, I'd agree with that. Is your leap of faith there moving into the subscription revenue and like
basically
generating revenue off people owning the vehicle rather than just the purchase?
Precisely.
Of the
vehicle's a commodity. Yeah, exactly.
So it's much more like an iPhone than it is like a F-150.
Yeah, in a different way, it's Apple's business model in a different industry.
Let's continue on a similar theme. Do you know much about electric vehicles, like, Lucid or Rivian or?
I know that the companies exist and I look at their stocks, but I haven't read much about the companies themselves.
Okay. Well, so like at a high level, like Lucid tried to be ultra premium, like almost a nicer Tesla that sells for well north of 100K, gets 500 miles, like is incredibly aerodynamic. It's kind of the hot thing right now. Well, their price just got destroyed. When your competitor takes their model that is supposed to be comparable to yours and does a 30 or 40% price cut, your company literally goes up in flames unless you find a way to cut your margins that much. And these are startups that are 10 years late to the game almost. When you look at Tesla, like these are new companies. Same with, I'd go with Rivian. I know the Cybertruck doesn't formally have a price yet, but like the people that are buying a Rivian are the people that are also shopping at a Tesla dealership and making a decision between those. And if the Rivian's $90,000, and again, your competitor cuts your price by 30 to 40%, like what does that do for your company? You're the startup guy on the show, but isn't this just part of this? Doesn't his logic have to be like, I'm just destroying all my competitors because I actually can right now? This means my margins are going to get really, really thin, and that's going to be tough for me. But also it might mean that I get rid of, right now there's 20 other competitors in the space, and I could get rid of 17 just by driving them out on price alone.
We could talk about this for a while. It depends. I think the logic that you're putting out makes sense, except when they're not competitors. When there's a different value proposition that someone is getting, let's zoom out into the future. I don't know what this is exactly, but I'm just laying it out conceptually.
Yeah.
If there's a different value proposition that you end up getting from a Lucid, because maybe they are building a car and they have an end-to-end system that is, I don't know, all well built together, and you have a closed engine, kind of like what Apple had versus Microsoft back in the day. I don't know, right? And you are buying that package. Whereas Tesla, if Tesla ends up being a commoditized product that you buy as a shell, but it's much more customizable, sure, they could be, you could coexist. I think is the point. Maybe I shouldn't say they're not competitors because, the ultimate value prop would be the same. But that's where it starts to, when you can segment the market in that way, you don't necessarily kill the competition. But it's fascinating for the reason that you stated. It makes the market so much more interesting than it was before.
Yeah, a quick story here. One of my neighbors bought a Model 3 years back, when the going price was like 65 to 70,000. the competitor for a Model 3 at that point was like BMW.
Yep.
It just was. It was, you were like, I'm buying a BMW or I'm buying Tesla. And now it's literally, I have other neighbors that are like, should I buy a Prius or a Model 3? Because the price has gone down so much. It's just fascinating to me. I just can't get over it.
Who thought that cars were going to become, like, if you go back, I don't know, 15 years ago, that cars were going to be such an interesting business like they are right now. It's super cool. I'm reading When the Heavens Went on Sale right now, which is an Ashley Vance book written about the space race. It's called, so it's all the organizations, companies at all that have been getting into space for the last period of time. Ashley Vance also wrote a book on Tesla / Elon, and it's interesting, like relevant. It's relevant for this conversation because of the way that, just going to talk about Elon for a second, the way that Elon has changed the way that full industries like space are even viewed. And I think that that's where cars have also happened. It like rejiggers the way that America, or the way that the world, I don't know why I just said America, the way that the world views cars. It's super cool. I'm actually not that into it, but I think it's cool intellectually. Can I shift to something I am into?
Yes.
So I came across on the Twitters, or whatever it's called, I came across this 2006 guest lecture by Li Lu. Li Lu he's one of the favorite investors of the best investors, is the way that I would describe him. So he's not well known out in the like broader world like a Warren Buffett typically would, but if you talk to a Warren Buffett or Howard Marks or Seth Klarman, and when Li Lu is like who comes up, and
it's like the rapper that Drake listens to.
Sure,
Come on.
It's the rapper that Drake keeps in his golden toilet bowls or whatever that he buys.
Exactly.
So
it's the
Li Lu,
CD that he has in his Birkin bag.
Yeah. Oh man, kill me. So Li Lu went and talked to Columbia Business School in 2006. That's what this clip's from. It's like an hour and 40 minutes of what I would call gold for a variety of reasons. My favorite part about this is Li Lu he doesn't state this, but I'm going to say disappointed at one point in this group that he's talking to.
But this is my favorite part. It's like half the 30 minutes of the thing is him calling the Columbia business students dumb, basically.
Yeah.
I just loved it. He's like, you can't do this math in your head. Like what? And then Bruce Greenberg Greenberg, am I saying that right?
Greenwald, maybe it's something like that. I can't remember.
Greenwald, yeah, there we go. He's like yelling at the professor, basically, like, what are you teaching these students? They don't know anything. I've just loved this because if I was in that class, I would like they also didn't do the homework he asked him to do. I would have been like all over this, Doogles. Yeah. I would have had my notes would have been like 7 pages long, and these guys didn't come across. It wasn't a very impressive performance.
And my interpretation of Li Lu's facial expressions was, first it was shock. Like, I think there was a moment where he first went, maybe I'm not asking the question. And the question was, what is the market cap of this company? That was the question, by the way. And I think he was like, maybe I'm not asking the question right, at least just from the way his facial expression looked to me. And then at some point he went, no, I'm Li Lu. I understand how to ask what a market cap is. Why don't y'all know how to do this? And he says, it's like, if you can't do this type of quick analysis in your head in like split second, you will never make it in this business. Straight up, just throws that out there, which I thought was powerful. And then I feel like that was a bit of a turning point in the full conversation where he just became more declarative and blunt.
He was really blunt.
Need to learn.
He was really blunt and really confident.
The 2 points around disappointment, where there was the first one around market cap, and there was another point toward the very end of the talk where he brought up that the most fascinating businesses for him are the ones where the advantage of the business just gets stronger and stronger the more the business goes on. And he says, what are examples of that? And people were throwing out examples, and he kept basically nodding. He'd be like, yep. And then finally someone says, are you agreeing with all of these? Because it wasn't clear whether he was just appeasing, agreeing, or what. Are you agreeing with all of these? And he said, well, you're basically just reciting Warren Buffett's portfolio. Can you come up with some that are your own thoughts? And I was like, bam! Not that he needed a mic drop, but it was kind of like it was more like one of those mics that is on a cord, like a mic swing around and smack people in the face with it. I think it was a phenomenal wake up call for folks. So those are 2 points I like. There are a few others, but I'm going to pause.
Besides that, which was a really fun chuckle, I loved he broke down Timberland as a company.
Yeah.
The shoe manufacturer, right?
Not the rapper.
And it's the shoes that the rapper wears.
Yeah,
going back to our Drake analogy.
That is true.
So this is from memory. I don't have great notes here. So help me out, Doogles. But he walks through an investment he made that went up 10 plus times. I mean, just crushed.
It was like 7x in 2 years. It was something like that.
It was Timberland. And basically they had solid profits for a long time. It was really small. I think it was 200 million in market cap, something like that. And it was entirely like all the voting rights were owned by the family. And because it was profitable, the family didn't even need money on the capital markets. So there were some lawsuits in play. Effectively, all the lawsuits said is the management team doesn't give me any guidance on future revenues or anything else. Because the family and the leader of the company just got frustrated with dealing with the nonsense of having conference calls with analysts. And
exactly,
I love that. My favorite people in the world are much more like Buffett in terms of, I don't care what any of these analysts think about my company. Like, watch the dollars roll in the door. Like, I'm not going to tell you about XYZ or our strategy for this or what expense reductions we're currently running. I'm just going to show you that my business crushes, and then you're going to throw money at me. Like, those are my favorite management teams, and they're very tough to find. So anyway, this management team just got sick of playing the game, and that had alienated a lot of customers and really hurt the stock price. Made this thing a bargain. This is where I don't remember, but the price that he was able to buy in was like less than half of book. Something
like that.
It was dirt cheap, despite the fact that they had strong return on equity, great cash position. It's everything you want. So he actually cusses a lot in the lecture, but this is where he talks about the size of his position, and he basically just says it was freaking massive. The other thing there wasn't a quantity that he stated. It was all like when a number's so big, the only way to describe it is blank
words.
Ton.
Yeah, exactly.
A blank ton. So anyway, he sees very quickly, like I'd say within 5 minutes of going through the financials based on the talk, that this thing's a massive deal. So his question then goes to, I need to know the character of the people that run this company, because there's either fraud going on or I'm buying a blank ton of this, right? That's basically where he went to within 5 minutes, because he's so gifted at like the analytics side of the financial analysis. This is where he's a little different than maybe me or you, Doogles. He happens to call around, figures out that the son of the CEO of that company is on a board that is a company that one of his friends owns, and pulls some strings to get on that same board, befriends the guy, simply like lies to him, as it sounded to me, Doogles. So he basically pretends to like the guy when he really just wants to know if his dad is stealing from the company or not. Once he figures out that they're a stand-up family, he puts a ton of money there, makes a 7+X return, and they become real friends. I mean, like, no brainer investment.
And it was where the 7x came from. He said there was multiple expansion. So it went from a 5 to 15x price to earnings ratio, while earnings were growing 30% a year. So you had multiple expansion and fast earnings expansion. Super cool. He then, can I transition from Timberland? You got more?
Yeah.
So then he says, and this point is similar-ish to what you talked about with Buffett, but it's either a more nuanced and finer point version, or maybe it's just different. He said that over the course of your decades-long career, if that's what you have in investing, you're likely to get 10 to 15 high conviction opportunities. So this is where it's different than what we brought up before, is that he's not saying that you'll only invest in 10 to 15 companies ever. He's saying there are 10 to 15 opportunities that are the ones that you throw everything into. Like that's basically what he's saying over decades. And Timbaland was I don't think even made that bar, because one of the things he said was, he was like, yeah, you get a 5, 6, 7x return. That's cute. I'm talking about the ones that are going to pay your entire, I'll call it fund, as you would in the VC. Like you're getting 10,000 times your size. Those are the ones. And he wouldn't name those. Like he said, though, like the names that you are hearing here are not the names that are my highest conviction stocks. You won't know what those are. And do you remember this when he was talking about this?
Yeah, I don't remember the 100+X conversation, but he was not talking about anything that he was currently invested in. So all these examples were long ago, and he had already exited.
Yeah, exactly. And this came out even further when someone asked him, what's your sell criteria? And he said his sell criteria used to be, if I wouldn't buy it today, then I sell it. And then for these high conviction stocks especially, it changed. And he started viewing this as they're effectively like a forever hold. Not exactly that, but what he said, he started thinking about is, he said, if you view continuing to hold a stock as you're getting a 30 to 40% loan from the government, and what he's saying there is, if I sold, I would have to pay capital gains tax.
Yeah. Saying
if you view that and you look at your return on invested capital, which for the types of companies he's talking about is a 50 to 100% return on invested capital. He goes, what I'm getting is an interest-free loan that would normally be a 30 to 40% like cut, with 50 to 100% returns. For these high conviction stocks, I'm able to see 10 plus years out of what these stocks are going to be able to do. And how am I going to turn down a 50 to 100% interest-free loan from the government compounded over that period of time? Now, this is some like next level, do not try this at home type stuff that he is talking about. Because the level of, when he says high conviction, going back to the meeting of the neighbors and joining boards and all this stuff, he's saying that you know everything about accurate and complete information, I believe is the phrase he used. You know everything about these organizations and the industries, or he knows everything about these organizations and industries. So that's what he's making. It's like mind blowing.
Two important points to add. One, he says that you're perfectly allowed to have a high conviction position and then sell. Like, then find out new information, realize a hypothesis you had was wrong, watch the thing go down 20 to 30% and sell. So that it's high conviction until it's not, right? In most cases, I'm sure it's like, but he allows himself to take in new information. The other thing I loved is he doesn't hire any I'll call it professionals trained and analysts. Like he doesn't hire people from Columbia Business School. He says it's too much common sense, and that, I forget the exact phrasing he used, but like he just basically wants someone who's smart off the street. That's like, how does this company make money? Why? How is that sustainable? Like, he was great at asking the relevant questions and not getting lost in the details. Yeah. Basically, he'd look at 5 metrics on the balance sheet and run with an investment hypothesis. Like, it is really impressive to watch.
It's super impressive. Very much recommend. It's an hour and 40 minutes, so that's a lot of time. But for those that like to go deep on this stuff, highly recommend this. It is fascinating to watch how his brain was working during this, and it's in a conversational dialogue with a class, and so there's a lot more depth that can come from that as well. It was like super cool. Highly recommend it. We'll put on the Substack on Monday, skippydoogles.substack.com, so you can go and watch it.
Yeah. All right. I've been fascinated with Nvidia, and their stock price continues to go higher, which is like basically impossible. At this point, it's a paper airplane flying against gravity that has caught hurricane force winds to push it up. And we're just not sure how long this hurricane is going to last. Q2 revenue was off the charts, more than anyone thought possible, certainly more than I thought possible. But there's an interesting tidbit that came out this week. The large majority of that revenue came from just 2 customers. And to me, Doogles, this has always been my hypothesis with Nvidia. It's like you've had a few crazy people that wrote blank checks. It showed up all at once on top of this hype cycle with artificial intelligence. And like, I just don't know if I can't imagine the blank checks keep coming their way.
I mean, it's also, it gets back to what you mentioned, was that a few months ago, I think, with the insider selling. If your organization, and granted, they need to sign up to sell depending on where they are in the company, like a good amount ahead of time. So it's not like you can just do it that big on a whim. But if you have a company that is having a magnitude, it's billions and billions of dollars that you are bringing in every quarter, so your company ends up being worth over $1 trillion, and you're bringing in a quarter that is an order of magnitude larger than a quarter before, than a year before that same quarter, and that is a sustainable engine of a flywheel that's about to take off, you don't sell.
Well, and you might even buy. And at last I looked, I didn't look this week, but there had been no buys in the 400s and a ton of sales. These executives are smart. And again, history tells us, even with their huge Q2 reporting, the PE is still in the 200 somethings. Like
only, yeah.
It came down from 280 to 230 or something.
Yeah, exactly.
This isn't even worth talking about. It's just the garbage continues. I don't have anything to say with it.
And I should correct myself. When I said you don't sell, I meant you wouldn't see sales in massive waves across all executives, like you saw. A person like might sell. You know, you take money off the table. Like that's the thing that happens. But when you see all of the executives selling, it's very different. And this makes me think about our AMC conversation that we had before, although they're for very, very different companies, very different places and everything. But that's another case. If you're buying options in AMC and all of the executives are selling, and in fact, the CEO held 0 shares. They didn't just sell, they sold everything in AMC. That's not Nvidia. Oh my goodness. All right.
Well, yeah, but what's familiar is the bubble territory. Like
the
valuation for AMC back when the CEO sold every dime of everything he owned in that company was in a similar bubble territory.
Pretzels. I'm gonna talk about pretzels, specifically Auntie Anne's. That stuff's delicious, man. You get that cinnamon sugar up on there. Oh yeah, my goodness. And you dip it in that glaze. I don't think I've had one in like a decade or something. It's been a long time, but it's like it was yesterday. It's like it was yesterday.
The only problem to the mall right after this. Get some.
You gonna have an Orange Julius afterwards?
No, definitely
not. So there was a pretzel shop worker, 23 years old, part-time employee of Auntie Anne's. And what he did was he opened himself a brokerage account. He claimed he was earning $25,000 to $50,000 a year, which it's interesting because the fraud starts here. And it's not like he claimed that he was making $1 million a year. He claimed that he was making $25,000 to $50,000 a year, and he was making less than $5,000 a year. So that was where the first bit of misinformation, unchecked, right, by the organization. Then he linked this brokerage account to a bank account that had less than $1 in it. Then what did he do with that? They then allowed him to deposit $1 million into this account, like initiate $1 million. Okay,
who is they?
The brokerage. I don't know what brokerage it is, but to recap, he opens this brokerage account. He says he makes $25,000 to $50,000. He links it to a bank account that has less than $1 in it. He then proceeds to open up deposits or start deposits for $1 million into this account. Because he started those deposits of $1 million, they said, immediately you can have access to $200,000. He then took that $200,000 and wisely invested it in Apple, GameStop, Nvidia, AMC, and Tesla. $85,000 in Apple, $78,000 in GameStop, $22,000 in Nvidia, $13,000 in AMC. There's lots of problems with all of this. Then they got wise, like a couple days later. So they took control over the account, liquidated all the holdings, and the brokerage made 7K. So in the end, the brokerage made some money because the stocks happened to go up. The point of this is, if we've been talking about margin and whatnot here, and this just isn't even, I don't know what category you put this in that's just not straight up fraud, but this guy said it wasn't fraud, it was just a joke. Okay, I would say clear him, because that sounds about right.
Could this brokerage be anyone but Robinhood?
Exactly. It's like, this doesn't sound like Fidelity, it doesn't sound like Goldman Sachs.
Listen, I understand you can make 30K and be sitting on 10 million in cash. I understand that happens. It's probably not super rare. I don't really understand the desire to it's got to be Robinhood, because if someone truly has $1 million, just wait the 2.5 days for the money to actually clear into the account and then let them make some trades. They already opened a brokerage account with you. They already are apparently funding it with $1 million. That's good for your company. I don't really see the need for the 200K advance.
I do enjoy the faith. If you put everything else aside, on his part, if you put everything else aside, the capital allocation itself is interesting. Where's the place for you of your 200K you get access to? So $85,000 in Apple. Okay. $78,000 in GameStop. Okay. You're like, that's okay. Now I'm really curious about what your investing strategy, I'm gonna use the word strategy here, is.
There's no investing strategy here. None whatsoever.
22,000 Nvidia, 13,000 AMC. Okay, it gets more confusing. And then $700 in Tesla. What? Oh, anyway. Okay.
My question is, what if he would have day traded? What if he would have actually made $1,000, sold everything, closed the account?
He almost did it.
Would that be his $1,000?
He almost did. I actually, I don't know. I don't know what happens. I assume they come after him, because they never would have seen the money at that point. There was never a point where he had money in with their brokerage.
Yeah, totally.
So I don't know. All right, next quick hit. I want to talk about Nick Maguilli, who we've discussed a couple times on here. Actually, we discussed a bunch of times over the years here. But recently, there have been a couple times where we brought up posts of Nick's and went, this just doesn't sound like Nick. Nick has these well thought out, balanced posts that are really interesting to read. And then there are these posts. There was one that came out in an unnecessarily angry tone, I would say. And then I can't remember what the other one was, but we kind of just said, what the dilly be at? What came out this week?
Well, you didn't tell that story, right? 2 weeks ago, Doogles was on the podcast being like, Nick, if you're being held against your will, call us. You have code words or something.
Yeah.
You're pretty dramatic about Nick's change in writing fortunes here.
It seemed like something was going on. That's why. Something bad was going on.
We like Nick, and we still like Nick, but I don't have the tweet in front of me, Doogles, but he basically said he had taken on an adventure for several months, I think for the past 9 months, of trying to write to increase his Google page rankings rather than write things that he was passionate about, which I think is the stuff we're used to years ago from Nick, that is typically really quality stuff. It's fascinating to me.
It is, because there was a part of me, for all the reasons you described, I was kind of like, is it just us? Am I being let me talk about Doogles. Am I being a hater right now on something that maybe I've just become a curmudgeon? This is the way the world is. And then the way that the tweet that you were talking about comes out is, I have a confession to make. I went, oh, okay. So there was something going on. Nick, I applaud you for a few reasons. Applaud you for all the writing that you've done. One, it's hard to write that much over this length of time, including a book. So phenomenal. Your writing's been historically awesome. Couple hiccups, maybe a few hiccups recently, but coming out with something like this, that's character. It's a lot of character to be able to come and, well, I guess probably about 140 characters. But to come out with something like this is serious character. So I applaud you.
My favorite experiment that's happening in real time is Musk on Twitter/X starting to write checks to the creators. I don't know how much you see of that, Doogles, but it has changed people's behavior. I mean, the joke in a lot of organizations I've worked in about salespeople has always been that they're coin operated, right? It's kind of made these content creators on Twitter coin operated as well. And you see all sorts of changes in how and what people post to try and increase engagement because that actually increases a paycheck, excuse me. And it's very much like a YouTube model. I found it fascinating to watch because if you go back to Munger talking about tell me the incentives and I'll tell you what the behavior will be. What Musk did on Twitter is change the incentives, and you almost immediately, like I'm talking within 15 minutes of the first paychecks hitting, saw people's behavior change.
Yeah.
At this point, I don't know if it's good or bad. I think it's probably bad because there's more people putting out, in some cases, falsehoods simply for engagement. But it's fascinating to watch.
I think we're in fascinating times. That's all I got to say. Fascinating times. And that wraps up with my last quick hit here around consumers. I know y'all have heard me talk. You heard me talk several times about the state of consumers. I do not feel positive about where we're going there, but I hope that I'm wrong. But then evidence keeps coming out. I'm like Dick Tracy up in this joint, seeing evidence. So a couple things that came out. We'll put these on the Substack. We passed $1 trillion in credit card debt for the first time, which an absolute figure like that doesn't necessarily say anything by itself, but we passed $1 trillion in credit card debt. Yeah. Interest rates on average have gone from a little over 16% to a little over 22% over the past year. So the combination of those two could be kind of bad.
Yeah, just credit card interest rates to clarify.
Yeah. Yes. Sorry. Just credit card interest rates. That was not the Fed funds rate. Although that's what you want, Skippy. Skippy wants to wake up one morning and see that the Fed funds rate is 22%.
We're going to talk about that in a second. We are.
What people have started doing, it seems, is opening up new lines of credit to pay off old ones. So you get that through 0% interest new credit cards, and then also through loans that people are pulling out. And what studies have shown is that when people do this, they end up building their balance up to what it was before within 18 months. So that's not positive. There's an estimate that by Q2 of next year, the entirety of households' pandemic war chests, as they're calling it, of cash will be spent. And banks are greatly slowing down loans that they're giving out. So the summary of this is people's debts are high. Banks are saying, we're going to be more reluctant in the future to give you more loans to pay off those debts, and cash is running out. And so something's got to give. I hope the thing that gives is spending. Like that is really what because if spending gives at a non-cliff rate, that can be helpful for the consumer. It will not be helpful necessarily for GDP and economic growth, but be helpful for the consumer. If it's a cliff, meaning if we just keep spending until they can't spend anymore, that's going to hurt the economy and the consumer. And I hope that doesn't happen. That's it.
All right. You talked about interest rates. Mm-hmm. I'm going to piggyback off of that. Hypothetical, it's tough to state, but Doogles, what does let's call it the 10-year treasury interest rate have to be for you to be comfortable moving all your equity investments to bonds? What rate
for me
would that be? Is it 10%? Is it 15%? Is it 20%?
For Doogles?
If you could get a guaranteed return backed by the U.S. government for 10 years, how high does the rate have to be for you to think that that's the best deal available?
You're asking for Doogles.
Yeah, for you.
Yeah. Well, that's a good question. I would probably say somewhere 13% at least.
See, I'm in the 12 to 15 as well. I mean, 15, if someone was like, hey, you don't have to deal with any of the turbulence of the stock market, and I'm going to give you a 15% return, and that's going to be guaranteed for the next 10 years. I'm going, All right.
Yeah,
Here's some cash.
I mean,
Like
15 is definitive. I wouldn't go 100% just because I'd have like, but it'd be like 95, and then I'd play
I mean,
around.
my other money
But
would be like playing with it.
yeah,
And
exactly.
what happens then is then if the 10 years at 15%, stocks get so cheap that I'd be doing
Oh
some analysis
yeah,
on the side where I'd be like, this is at a PE of 2 with an ROE of 27 and like balance sheet is gold. And I'm going, this is a 50% year over year return. So eventually the money
yeah.
pulls back because that's how these things work. But
You come back in like Macho Man, talking about, oh yeah, that is exactly what you would do. I know that'd be quite a world. I'd wonder what the heck else is going on if you're offering me 15% free money. Person on the phone claiming to be from Nigeria. I'd wonder what else is going on.
well, it would mean things got pretty tough. I mean, yeah, that's not an easy investing environment.
No,
But
it's
my
not
goodness.
1981, 1982 is what that is. Whew. Yeah, that's an interesting question though. But I think that's right. That's the number that came to my head, somewhere around 13%. Makes sense, around the same place.
13 is pretty juicy too. And like once we get north of 10, I think I'm shifting more cash that way. Again, it's none of this is 100%, but like I could be pretty comfortable having a decent chunk of my portfolio making 10% risk free.
I know it's not 6. What's interesting,
because we're there.
yeah, because we're there. What's interesting is if you go back, what was that, 2 years ago when the I bonds hit 9, was it 9.6,
Yeah.
9.8, something like that. Let's just call it 10% for all intents and purposes. When that hit 10%, I'm like, what I'm thinking through is there was the limit where I'm saying only as if this is not a lot of money. I know it is a lot of money, but you could only put 10K into I bonds per year. And what I'm thinking back to is if that limit wasn't there, what would that have looked like? And I don't know because the limiter was there. So like that never was a thought exercise that I went through. But it's kind of fascinating. If that was unlimited, what would have happened?
Yeah. And so that's even a different time where your standard interest rate at like a bank was less than 1%, where now it's 5-ish%, right?
Yeah,
so
exactly.
Yeah, I know I was maximum. I mean, it's a interesting one. I wouldn't have gone with 100% of my allocation there, but I certainly would have put more than the 10K. Yeah.
Mm-hmm. Yeah, it would have been very substantial. Cool. I think
All
that's
right,
a wrap
guys.
for
That's
us,
a wrap
right?
this week. Yeah. Hope you enjoyed the usual banter. Hit us, listener mail at Skippy Doogles. Premium to subscriptions to get the show early. It's only $7 a month. Supercast or skippydoogles.supercast.com. Substack is a great place to get all the articles we talk about on a weekly basis. That's skippydoogles.substack.com. Twitter at skippydoogles. You can find us all over the place. You can even go to skippydoogles.com if you're looking to hunt down any of those things I just mentioned. We'll see you next week.
Thank you.